Hello, it's May, it's World Economic News, and we'll start with the UK Telegraph. And America's reckless money printing could put the world back into crisis. An article by Liam Halligan. Last week, Ben Bernanke suggested that the US base interest rate will stay close to zero for an extended period. It's been there since December 2008. Traders took these words to mean that the Federal Reserve won't hike rates until the first few months of 2012 at the earliest. Now, that's going to mean zero interest rate policy for 2009, 10 and 11. At least. That's 3 whole years of zero interest rate policy. Now, I'm pushing this again, as I so often do, just to show that there is something different about what's going on. It is differently wrong. It's a lot more differently wrong than other. It's not just a recession. It's not even just a depression. It's something is going on that's completely differently wrong. All right, I'll move on. An article by Rogue Economists: Austrians and MMTers should be on the same side. Austrians and MMTers should be on the same side. After all, both camps understand the relationship between money and credit, and both understand the full ramifications of having fiat money. They should be on the same side, arguing against economists who argue that demand can be created by flooding the banking system with reserves. And both should be on the same side, arguing against those who think that increasing inflation expectations is an effective way to get an already over-indebted economy to take on more debt. And I bring this up because I think it's quite important to show that Austrians and MMTers are different from the mainstream, and it is worth pointing out and stressing the similarities rather than the differences, which is so often done. Interesting article, and we will return to it later. This is from the transcript of Ben Bernanke and the question and answer session after the Fed's open mouth committee a couple of days ago. After all, the Fed can't create more oil. This is Bernanke in a question about gas prices. We don't control the growth rates of emerging market economies. This is brilliant. It's just Bernanke admitting or saying that the Fed can't create more oil. Brilliant, normal, accepted. What he goes on to say just after that is a bit bizarre. What we can do is basically try to keep higher gas prices from passing into other prices and wages throughout the economy and creating a broader inflation that would be much more difficult to extinguish. Now, I don't understand what he's saying there, but he's saying what we can do is basically try and keep higher gas prices from passing into other prices and wages. How the Fed can do that, I don't know, but the Fed thinks it can do that. Thinks it can stop higher gas prices from passing into other prices and wages. But most important, and I think underlying a lot of what I say here, because it's over the peak, after all, the Fed can't create more oil. It can create more money to buy more oil, but it can't create more oil. So on that, next article: do you want to measure GDP in real stuff? Last April, $14.5 trillion, that's the US GDP, would have bought about 180 billion barrels of oil at $80 a barrel. Now this year it buys about 130 billion barrels, which is down about 30%. So a year ago, the GDP of the United States would buy 180 billion barrels of oil, and now will buy about 130 billion barrels of oil. And somewhere along the line, that's important. Back to the Austrians and MMT things pulled out, but regardless, both can look at the economy granularly. In other words, and can analyse it. MMTers and Austrians are analytical type thinkers and see debtors and creditors, investors and investees. Mainstreamers, those pump monkeys on the television, only see buyers and sellers and believe that just dropping money will solve the problem of non-existent buyers. There is no such thing as a balance sheet recession to the mainstream, no such thing as leveraging or deleveraging, which hopefully now we're understanding is crucially important. And just to show this, I've dragged out the ratio of personal savings to personal consumption expenditures from the Bureau of Economic Analysis, United States. And you can see going back to 1960, the trends are, let's say there are 3 trends, are perfectly clear. I've put the lines in to make it look even, so it's even clearer. And you can see the first inflection point is about after the oil shocks of the 70s and 80s, about mid-80s, personal saving to personal consumption starts going down from about 10%, heading down towards 0. And you can see from 2007, the recession thing onwards, it's starting to crawl back up again. Leveraging and deleveraging, and how important that is, and what Richard Koo says about it, because Japan have been through it all. What Richard Koo says will not all be right, but it gives us a good basis for thinking. Right, the big picture, Barry Ritholtz, Bank Arbitrage, JPM. At yesterday's presser, Fed Chief Bernanke indicated an easy policy stance for the foreseeable future. We've dealt with that. While the basis of this is ostensibly high unemployment, I believe it is really to buy time to rehabilitate the bank's balance sheets. They remain poorly capitalized, unbalanced. Rather than put insolvent institutions into reorg, we have allowed them to hang on and slowly get better through massive backdoor bailouts. Borrowing from the Fed at near 0% and lending it right back to the Treasury at 2 to 3%. This is more politically acceptable than just writing them checks for hundreds of billions of dollars. And that seems to be what is going on. Huffington Post Business, the 10 countries where unemployment rose most during the recession. 10 countries, but we'll start at number 5 because we find the United States there, where unemployment rose 4.7% between 2007 and 2009 and has now got in unemployment at about 9.5%, something around there. Yeah, I think so. And should get used to the fact that this is now structural. It won't be going away. Iceland, we can imagine why Iceland's there at number 4. Poor old Ireland at number 3. Estonia, goodbye communism, welcome to capitalism at number 2. And Spain, unemployment rose 9.6% between 2007 and 2009 and now has an unemployment rate of 21.3%. Next article, I'll read you this small bit from it, but the whole article's worth reading, obviously link below. Now that we have Russia and China on board with this capitalism thing, we are more efficient at exploiting the global labour force than ever. Corporate profits, other than 2008, have climbed an average of 13% a year without increasing wages a single cent over that same time period. Corporate profits have climbed to their highest share of national income for 64 years, while the share going to wages has sunk to its lowest level since 1929. Perhaps there hasn't ever been a better time to invest in corporate America than right now. Our global GDP has climbed to about $55 trillion, up 100% in 20 years. And the best news of all is that we've made sure that over $21.5 trillion of that, 71%, growth went to the top 10% of the populations. keeping the money amongst ourselves, we can be sure that it goes where we want it to. And there's a little graph there of share of US family net worth, with the top 10% with about 3/4, and the bottom 90% with about 1/4 of net worths. Yeah. Credit Crumbs gives us this. It's a comment on Mish's blog, but I thought it was worth putting in here because it sums things up quite nicely. It's on an article of Mish's about the US's reserve currency status. That doesn't really matter. Starting second paragraph down, he goes, or she, questioning whether the US benefits or not from the reserve currency status is meaningless. The right question is who in the US benefits from reserve currency status, and who gets harmed from reserve currency status. Capital owners and fire economy, that's finance, insurance and real estate, benefit from the reserve currency status. Labour owners are harmed by the reserve currency status. Now, it's a bit of a weird way he's put in it. Labour owners, he just means you and me, I think. Yeah, it's what he means. Let you and me. We have our own physical, what we can give, what we have to sell into the corporate world. We have our own physical labour, our mental labour, and a combination of the two. What we can give is that's what we can give, what we can sell. Labour owners, it's us again, are harmed by the reserve currency status. It is, as it has always been, the battle of capital owners versus labour owners. Capital owners benefit from the reserve currency status in two ways. Reserve currency status allows other countries to peg and undervalue their currencies against the US dollar. This allows them to grow fast and at the same time steal industrial capacity from the US. Capital owners benefit as production costs decline and profit margins increase. Labour owners lose because they lost their jobs that go along with the industrial capacity. Funny way of saying it, but we understand what he means, that we get laid off because we're too expensive and capital can go and get cheaper labour elsewhere. Reserve currency status, this is number 2, reserve currency status allows money to be printed to cover the trade deficit, and it allows money to be printed for other things as well, but trade deficit, the newly printed money appears as debt due to our central bank system, carried by the labour owners, the taxpayers, the labourers. Capital owners enjoy the capital gain and interest payment without work. Labour owners must increase debts in order to cover the trade deficit and everything else. Well, that's it for the 1st of May World Economic News. See you for the rest of the week. Bye.